Let's understand this with the help of an example. This guy, Hari Prasad, has a tea stall in Jaipur and his business is called the Jaipur Tea Stall. Now Hari's business is flourishing and he's making 5 lakhs a year from his tea business. Now Hari is planning to move to Delhi and he is looking to sell his Jaipur tea stall. So Hari gets 3 prospective buyers for his tea business. Buyer 1 believes that the business is well set and has got good future prospects. So he is willing to pay rupees 20 lakhs for the Jaipur tea stall. Buyer 2, who is even more positive and confident, is ready to pay rupees 25 lakhs for the same business. The third buyer, however, is not that confident and is ready to pay only rupees 15 lakhs for Jaipur tea stall. So this means that buyer 1 is ready to pay 4 times the annual earnings of the business. Buyer 2 is ready to pay 5 times the annual earnings of the business. And buyer 3 is ready to pay only 3 times the annual earnings of the business. So Hari will obviously sell to the highest bidder, which in this case is buyer 2. Suddenly, Hari's father fell ill and so he dropped the idea of selling his business and moving to Delhi. And now he starts expanding his business. He has opened 2 more stalls and he has also started catering tea in corporates. So now, after 2 years, Hari has a big business and he's making 20 lakhs a year from his tea business. Things in his family have settled down and he's again planning to move to Delhi and is looking to sell his Jaipur tea stall. So what do you think? Should Hari be getting a higher price for his business this time when his business has expanded and sales have increased? So let's see what happened. So this time again, he gets 3 prospective buyers for his business. Buyer 1, this time, is ready to pay 80 lakhs for the business. Buyer 2 is willing to pay rupees 1 crore for the business. And buyer 3 is ready to pay rupees 1.2 crore for the same business. So this means buyer 1 is ready to pay 4 times the earnings. Buyer 2 is ready to pay 5 times the earnings. And buyer 3 is ready to pay 6 times the earnings of the business. Now whether Hari sold his Jaipur tea stall or not doesn't matter here. What matters is the fact that the price or the value of the business grew as the profits grew. Therefore, we conclude that the price of the business depends upon the profits of the business and the willingness of the buyers to pay. And hence, the formula for price of a business is the earnings or the profits generated by the business multiplied by the number of times these earnings the buyers are willing to pay. The value of a business grows as the profits grow. As we saw in our tea business example, when the profits were rupees 5 lakhs, the buyers were willing to pay between 15 lakhs to 25 lakhs. And when the profits grew to 20 lakhs, then the buyers were willing to pay between 80 lakhs to 1.2 crore for the same business. Therefore, earnings is the most important component to determine the value of any business. Now, when we talk about investing in a company, we mean buying shares of that company. So hence, this price will be on a per share basis. So let's extend this analogy to a company. Let's take the example of a company, say ONGC, and see where the price of 1 share of ONGC comes from. Let's say ONGC has 1 crore shares issued and outstanding in the market and its profit last year was rupees 15 crore. So, the earnings per share for ONGC's shareholders is the profits divided by shares outstanding, rupees 15 per share. Let's say the shares of ONGC are currently trading at rupees 165 per share. With this information, we can find out how many times the investors are willing to pay for ONGC's earnings, which is called the price to earnings ratio or the PE ratio. And the PE ratio can be calculated with the help of this formula, the share price or the market price of ONGC divided by its earnings per share. So the PE ratio of ONGC in this case would be 11 times, or we can call it 11x. The study of PE is very important while investing. A stock can be cheap or expensive not on the basis of its price, but on the basis of its PE. If the PE of a stock is low than the market average, then it means that the stock is cheap. And on the other hand, if the PE is higher than the average, then the stock is considered to be expensive. Now, let's look at the average PE number of the Sensex. This graph shows the average PE of the Sensex for the period Jan 1991 until May 2018, a period of 27 years. Over this long period of time, the average PE of the Sensex has remained at 20.58, represented by this black line. So the times when the Sensex PE was below the black line, so it means that the Sensex was cheap. And when the Sensex PE was above the black line, that is above 20.58, so at those times the Sensex was expensive. So PE is the right way to assess if the Sensex is cheap or expensive rather than its value. This implies that in the year 2000, when the Sensex was around 5,000 and the PE, as we can see from the chart, was around 30, at this time, the Sensex was more expensive than the year 2018 when the value of the Sensex is 35,000 and the PE is 25. Another point to note here is that both the ends of very high PE or a very low PE cannot be sustained for long. If you look at the graph closely, in the year 1992, the PE of the Sensex was around 55 times. Soon thereafter, the markets corrected and the PE of the Sensex fell down sharply. A similar trend can be witnessed here in the year 94-95 when the PE of the Sensex was in the range of 45 to 50. Again the markets corrected, thus restoring the PE. Similarly, when the PE was at extreme lows, like in the year 1999 when the PE was at around 10, or in the year 2009 when the PE was at around 12, and soon the markets have accelerated to restore the PE. Similarly, there are various times over the history of the Sensex when the PE has either fallen below or has risen above the average PE. But over the long term, the average PE of the Sensex has remained at around 20. And with this, we conclude our topic of basics of equity. Thank you.